Hey, what's up guys, another video here. So today I want to talk about the Master Limited Partnership, the MLP, and why it is a dividend king. So this video may be a bit boring, but we need to go over the basics of the MLP before you start or may choose to invest in it. Again, this is not financial advice, this is just an opinion. So MLPs were created in the 1980s by Congress in order to help a particular class of businesses raise capital from investors. In this case, any business that operates in the extraction, transportation, or processing of natural resources. So this can include, for example, liquefied natural gas or petroleum. So the majority of MLPs operate in the oil and gas sector, particularly in the midstream space. A midstream MLP or MLPs are those that specialize in the gathering, storage, processing, and transportation of oil, gas, and refined petrochemicals. Midstream MLPs generally derive most of their cash flow from long-term fixed fee contracts, which makes their cash flow far less volatile than that of regular oil and gas companies who are at the mercy of cyclical commodity prices. So basically what this is stating, and sorry, this is coming from a website called Simply Safe Dividends. Basically what they're saying is it's not as dependent upon the price of a commodity such as oil. As you saw earlier in the year that the price of oil were actually negative. They actually own these pipelines and they have fixed fee contracts for these oil companies to use these pipelines for transportation basically. So it is generally cheaper for massive amounts of natural resources to be transported by pipeline as opposed to a truck or rail. So that's why it's more advantageous to use these type of services. So as you can see, many oil companies such as Exxon or BP or whatnot, their share prices fluctuate greatly based on the news of a commodity price, again, in this case, which is oil. So, this isn't as dependent upon the cyclical price. So that's why, people like to invest in MLPs. And MLPs, they are similar in the sense that they will usually give a quarterly dividend, and I'll get into the specifics why it's more advantageous. But essentially, the MLPs are a special type of company known as a pass-through entity, which means that the partnership doesn't pay corporate taxes because it passes through its cash flow and tax obligations to unit holders. So the unit holder is you, the shareholder. But in this case, we want to use unit holder because this is the specific term for someone who holds units of an MLP. And perhaps the biggest difference is that MLPs, because they pass on the majority of their cash flow as distributions, they retain very little earnings with which they can fund growth investments such as construction of a new pipeline. So basically, MLPs, they pass on the majority of the cash flow to the unit holders. So in this way, they're not paying tax. So corporations are taxed, at different levels. And I'm not going to go into the specific tax implications of MLPs, but just understand that you have a favorable tax advantage when you place your money in a taxable account. So if you have a taxable account, such as a brokerage account, and you don't place this money in an IRA, because if you place it in an IRA or another type of tax advantage account, then you may owe additional tax on it. And again, that's a whole different story. But basically, what you want to know as a retail investor is to invest or place this money or invest in MLPs through a taxable account. So this is an after-tax account that you place money in. So let me go over a particular MLP that I do invest in currently. So the MLP that I invest in currently is called ET, Energy Transfer LP. And the time I got in, they are yielding about 19%. So this yield is pretty ridiculous. And they haven't had a break or a cut in their dividend, or I should say distribution, because when you're dealing with MLPs, the terminology you want to use is distribution. So they haven't had a cut in their distribution, and their stock has split 2 times, so 2-to-1 stock split. So basically for the MLP, instead of them issuing a 1099, they'll issue a K1, so that's for a partnership. And you may be liable for taxes in multiple states because many of these MLPs, they operate across various states. So again, just FYI. So if you do have a professional tax preparer, you may have a higher taxable because they're going to charge for each K1 that is issued. So it may become more expensive during tax time if you do have a tax preparer. And let me give you a slight high-level overview of how these distributions work. So a distribution from MLP is called an ROC, a return on capital. So basically, when you have a return on capital, what's going to happen is it's going to lower your cost basis. So it's really different in the sense from a regular stock in that when you do get a distribution, aka a dividend, it's going to reduce your cost basis. So let me give you a quick example. Let's say you bought an MLP at $10 and you got a return on capital slash distribution slash dividend of, let's say, $5. So now it's going to lower your cost basis to $5. So you originally bought the MLP at $10, but you got a ROC of $5. It's going to reduce your cost basis to $5. And let's say the value of the unit went to $15. Now you have a larger difference between your cost basis and the actual current price of the unit. So instead of paying only $5 on the gains that you made because you haven't lowered your cost basis if you were in a regular type investment. So let's say you were in a regular C Corp investment and you place money into the fund at $10 per unit or per share and appreciate it to $15, you would only owe tax on that $5 of appreciation. However, in this case for an MLP, because you receive this quote unquote return on capital, aka distribution, aka dividend, it's going to lower your cost basis to $5. So we take $10 that you originally bought it at and we subtract $5 for the ROC. So 10 minus 5 is now 5. So the $5 cost basis, and using this hypothetical example, $15 for the current share price, now you owe essentially a lot more tax, or you owe tax on the greater difference because your cost base is lower because you did receive a ROC from an MLP. So again, the tax treatment of you receiving a distribution from an MLP is more favorable for a period of time versus a dividend from a C Corp. So just keep that in mind. I'm not going to go into all the tax implications, but basically, if you hold an MLP and you receive distributions in your taxable account, it is more tax advantage. Again, I'm not going to go into details, but that's the basic overview that you need to understand. So just to recap here, MLPs, a master limited partnership, is basically in the midstream space, and they're supporting the gathering, storage, processing, and transportation of oil, gas, and refined petrochemicals. They do have tax advantages, but again, if you do invest in it, it will lower your cost basis if you ever decide to sell. They will issue a K-1 as opposed to 1099, and you may be liable for taxes in multiple states. So again, it is more of a tax headache if you do decide to invest in it. Again, it's more complex during tax time, and a distribution is called a ROC, which lowers your cost basis over time. So you guys may want to read up into it a little more if you are investing. Just keep in mind the tax implications are a lot more complex, and they will give you a certain tax benefit, for an X amount of time if you do decide to receive cash distributions in the meantime. So again, hopefully this video isn't too confusing, but again, I am invested in an MLP called Energy Transfer LP. They are currently giving 19%, and who knows if they are actually going to continue this cash payout, but I'm pretty confident that it will. There was an implication with a pipeline that they own called DAPL, Dakota Access Pipeline. Again, it had a lot of troubles with legality in terms of going through Indian reservations and whatnot, and they recently got ordered to shut down on August 2nd, so that may have a dent in the revenue, but who knows what's going to happen with the cash payout, because the cash payout was similar as before, before the actual construction of DAPL. So let's keep that in mind. Again, this is a type of entity that you may want to invest in if you are trying to get really high dividend rate, and this is really much greater as opposed to a dividend that you may get in a stock such as XOM or, for example, AT&T. So keep that in mind. But again, the tax implications are much more complex. But again, it isn't all bad. And just keep in mind, during tax time, it may become extremely complex for you. But again, it shouldn't be a huge issue if you have a tax preparer or if you use a tax software such as TurboTax. So hopefully, guys, you learned something, and stay tuned for the next video.